Hello, it's Jonathan Wellham of Rocklinc Investment Partners, and it's May the 30th, 2016. Now, today I want to do a quick update on gold and precious metals in general, but specifically gold. As many of you know, I think all of you know, we maintain 7-8% of our investments in the precious metal sector. We might take that up to sort of 10%. In the right environment, but generally we want to maintain somewhere around the percentage weighting that we have currently. Now, we want exposure to precious metals because in our view it's a hedge, it's a protection against all of the debt that's been accumulated out in the global financial system. And we view the system as somewhat unstable, and therefore we want to be in businesses that can give us exposure to the precious metal sector, which we believe would actually go up in the middle of a crisis and hence provide a hedge for us. Now, let me give you the top 12 reasons why we have exposure to the sector and why we want to maintain our positioning. First, number one, this year so far, up until mid-May, we've seen some record flows into the gold sector. Now, that's gold inflows have been over $13 billion so far into ETFs and different investment products, over 11 million ounces actually into specific ETFs that are traded in the marketplaces. So there's a really strong underlying demand that is coming from the retail investor and also some institutional players, so strong demand. Number two, there's some major players, some very, very smart people that are making allocations to the gold market over the last number of months. This would include leaders in investing from Paul Singer to Stanley Druckenmiller to Jeffrey Grunlack, who is one of the top bond managers in the world, to even George Soros, who we would disagree on political issues, but certainly when it comes to investing, George Soros is a pretty sharp character. So you've got some major players allocating to gold because they also are concerned about the debt crisis that surrounds and sort of is enveloping the global market, if you will. Third, gold so far this year has been the top producer in terms of returns in the marketplace. And if you go back to 2000 with the tech bubble, and if you go back, so that's 16 years, gold has also been the best producing investment over the last 16 years, believe it or not. And so over this whole period of massive expansion of debt and interest rates continuing to go down, 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 even though gold has been volatile as a commodity, it's been the best performer, I should say, over the last 16 years and certainly year to date. Fourth, the narrative concerning gold has started to shift somewhat in the marketplace, and we're getting more and more conversations around, maybe this is more valuable. People are watching the sector more, and that's good because if we're an investor in this space, we want other people to step in after we've already built our positions, and this will give us a lot more upside and returns on the businesses we own. And so the narrative's starting to change. People are concerned about the central banks. There's less confidence in the European Central Bank, the Federal Reserve, the Bank of England, the Bank of China, the Bank of Japan. And as there's less confidence in the central banks, the narrative has become, hey, let's protect ourselves in terms of our investments. Fifth reason is that strategically, there's more and more well-placed investment professionals suggesting that gold should re-enter the monetary system. Now, I'm not suggesting it's going to, and nor are we investing in gold securities because people are suggesting it, should enter back into global arrangements. But when you have PIMCO, top economists at PIMCO, which is a large asset manager, suggesting that we need to potentially reprice assets against gold so that we can create inflation to help us with this debt crisis, that starts to become pretty interesting to investors. Sixth, even leaders out of Harvard, of all places, which really have rejected hard asset type of investing, but when you have Kenneth Rogoff out of Harvard suggesting that economies Emerging economies in particular need to build up their gold reserves and have at least 10% of their monetary reserves in gold. And this is a Harvard economist. Then something is changing. And so we look at that and we think, that's interesting. We would like to make sure we've got good positions in the sector. Seventh, the chief economist of the BIS, which is the Bankers International Settlement. So this is the bank to bankers. These are the big organization that controls bankers around the world out of Brussels. The chief economist there said that the global monetary system, the way it's been operating the last several decades, has no anchor. And so more and more the bankers are looking at the whole fiat currency system, the system that jettisoned a collateral standard, gold standard, 40 years plus ago, and they're starting to get a little bit concerned. So again, we're not suggesting they're going to anchor the global system in gold. Having said that, you can't continue to go forward on the basis that we've been operating without enough collateral. And if there is a debt crisis, people will need to reestablish some type of anchor to build confidence back in the system. So again, we like our positions. So that was the seventh reason. The eighth reason why we like gold is that China, India, Russia, many of the Far Eastern countries are buying gold in record amounts. And they're not buying it for their entertainment, they're buying it to help anchor their currencies and their economies. And so there's big buying that's coming out of the west, coming out of the east, I should say, as more and more gold is transferred from the Western countries to Eastern countries. And so the big demand there, and again, that demand is so that we can anchor currencies. Ninth, Canada, believe it or not, sold all of our gold reserves. And therefore, when we see the Canadian behavior being so irrational and so foolish and so short-sighted, it tells us that we should do the opposite trade when it comes to the Canadian market and our Canadian bank. They are really out to lunch and clueless in terms of their understanding of monetary conditions. So we'll take the opposite trade on that and do it all day long. 10th, negative interest rates are good for gold. And as we've talked before, with rates increasingly going negative in many parts of the world, and with over 8 trillion in government bonds trading at negative interest rates, it makes sense. Why would you own cash? You might as well own gold. At least you're not going to get charged anything, and it'll give you protection against currency debasement with negative interest rates. So that would be the 10th reason. 11th, much of the sector, the gold sector and mining companies, are really inexpensive. Even though they've come up so far this year, they still are relatively inexpensive. And many of them, most of them, have restructured their businesses so that they're much more profitable. They're much better investments today than they were 3, 4, 5 years ago. The last reason why we like to have exposure to this sector is that we own some great companies in this sector. We own the royalty and streaming companies. These are the finance companies. These are the companies that finance gold and silver mines. And over the last 3, 4 years, given the pressures that have been exerted on this sector, the companies with capital, the companies that can provide monies to the best mines, they've been able to cut really terrific deals. And so the companies that we have largest exposure to, Franco-Nevada, Royal Gold, Silver Wheaton, Sandstorm, have done a record number of transactions over the last 3 years. And this means that in 2016, even at these current prices, we should expect record profitability from the companies that we own. Record growth and record profits. So when you put all that together, those are the reasons why we want to maintain exposure to the precious metal sector. We do it carefully. We make sure that we diversify and get good exposure with some of the best companies, and then we maintain a reasonable weight in the portfolio, 7, 8, maybe up to 9% based upon conditions that we would see in the global marketplace. So I trust that's helpful. If you have any comments or questions, please do not hesitate to give us a shout. Thank you very much. Bye now.